Software stocks have recently taken quite the beating, and it's only right that we discuss it here at Chip Stock Investor. What follows is an excerpt from one of our live events that we have with our semi insiders, which you can get access to over at chipstockinvestor.com. And we had a very special guest to discuss this subject, Ryan Henderson of the Chit Chat Stocks podcast and of Fiscal.ai. Fiscal.ai is, of course, one of our partners that we use every single day here at Chip Stock Investor. Watch the video, see what Ryan's interested in, see what we're interested in the software space, and check out Chit Chat Stocks podcast anywhere you get your podcasts.
Let's talk about software now, because you mentioned it was a rough go when you guys launched your fund. And then ever since then, it's been a very hardware dominated market. Some analyst at some point in the past said Nvidia sucked the air out of the room. The air hasn't refilled the room yet for software companies. So I thought we'd start with just a couple of charts to tee up our next questions for you, Ryan. I think this is fascinating. We've shared this a number of times now, but the divergence between these charts is really incredible, especially around 2023 when Nvidia had the big moment where Jensen was like, hey, guys, we pulled in an extra $4 billion in revenue this quarter than we told you we would. Surprise. But it's only gotten worse since then. So obviously orange is the semiconductor ETF SMH. Software at the bottom is in purple. Over the last 5 years, really pitiful, as measured by IGV, the iShares software ETF, less than 50% total return in 5 years. And then just for fun, we threw in Vanguard mega cap and large cap growth, which has a mix of both, and also some really fantastic non-technology names mixed in, and 100% return over 5 years, which is fantastic.
I'm pulling up IGV on Fiscal here, because what I've noticed with a lot of the software sector ETFs is that they actually make it look better than it was. So Microsoft has done well, and obviously they are software, but they've had so much cloud dominance and cloud growth that it's really helped them beyond sort of their traditional office products and B2B SaaS traditionally. These are market cap weighted, I believe, a lot of these ETFs. So Palantir and Microsoft have been like a buoy for a lot of these ETFs. Whereas if you look at Adobe, Salesforce, some of these traditional software as a service models have had much worse returns than the ETF would indicate.
It's pretty incredible to see the composition of this ETF. And if you had to guess, what did this do over the last 5 years? I think a lot of folks would say it's done way better than a CAGR of less than 10% over the last 5 years, but it hasn't. It's been really terrible for a lot of these names.
I imagine that the composition here would have looked very different 5 years ago. I probably would have been Microsoft, Salesforce, Adobe at the top, and you've seen them just shrink as a percentage of the pie.
App 11 would be non-existent. CrowdStrike would be mostly non-existent. Yeah, it's been absolute just destruction. By comparison, I think everybody knows SMH, at least here, but the major outperformance immediately makes sense. Nvidia at the top, but pretty much every single one of these names has had an epic 5-year run. And then to round it out, we want to ask you some more questions, Ryan, about this. VUG, which is just the mega cap and large cap stocks within the S&P 500. So it's like about 300 holdings. They strip out all the value businesses, which is a very different company definition. And it's still been pretty fantastic. But what's incredible to look at here is the overlap. So many of these names from the semiconductor universe have outperformed so much in the last 5 years that now even like the S&P 500 is pretty overweight with semiconductors and hardware at this point.
Yeah, it's been a hardware decade so far since COVID. Hardware has just performed so well. And that's something I want to get your guys' take on, because it's not just the big hitters here like Nvidia and Broadcom, but a lot of the ancillary players, like the memory chip companies, have all had huge surges in revenue. And I'm curious, in such a historically cyclical industry, do we think it happens again? Do we think we see a down cycle, or are there enough tailwinds now behind them that this can last for a while?
We talked about US company CapEx at some point last year. And these cycles can be really long and dramatic for hardware and infrastructure. But the last big infrastructure cycle happened pre-financial crisis in 2008, 2009. And then we had a 15-year CapEx holiday, basically. And there's a lot of macro reasons as to why that was the case. Also, you had the cloud, which was incredible. If you wanted to adopt more software in your business, what better technology to come at exactly the right time in the aftermath of a financial crisis and no economic growth than being able to rent somebody else's hardware without making the upfront investment yourself. We've had 5 years now where infrastructure has taken over as the primary theme. And based on past cycles, they can be longer than we expect. But I guess every cycle is kind of like that, though, right? When you're thinking 5 to 10-year bull market, sometimes these themes can last much further than anyone expects. And so we're starting year 4 of this current growth cycle. I think we're definitely of the opinion that we're halfway through, but how much of the way halfway through is up for debate. There's some legs behind all of this, even though it's starting to feel a little bit uncomfortable with the valuations. These things can last a long time until we squeeze out every last bit of economic value from the current trend.
Yeah, at the end of the year, I went through the S&P 500, top performers, worst performers, cheapest, all that. And the top performers, 4 out of the top 5 were either memory chips or ancillary hardware providers to the chip industry. My knee-jerk reaction is always like, well, that can't last. And I think that every year the top performers in the S&P 500, I'm like, that can't last. But like you guys said, I think there's legs. And obviously, people thought that about Nvidia last year and probably the year before as well.
So everybody wants to know, especially the value investing crowd, what's a good deal in software right now? And then maybe as a follow-up, we should talk about when is the software industry going to inflect thanks to all of the hardware infrastructure build out. But maybe let's start with the first part of that. What's currently of value in your opinion?
For the second part of your question, I'm not sure what the catalyst is for a lot of these. Maybe there isn't a catalyst. Maybe it's just consistent capital returns from here and slightly slower growth than people expect. But the 4 software companies that I own currently, and people would not call software, Remitly and Airbnb, that's travel and payments. The other 2 are Adobe and Monday.com, which are one's more enterprise, but Monday.com, it's more your traditional go-to-market approach of getting in front of people and actually signing a contract. Remitly is a digital remittance app, as the name implies. They've got 9 million active customers. I think it's grown from about 1 million active customers to 9 million over the last 5 years. At the end of 2019, they had 948,000 customers, and today they've got 8.9 million. So it's been a very good 5-6 years in terms of getting customers in the door. And the market seems to have soured on them. A lot of people are worried about some of the political risks with immigration and that being sort of a headwind to growth, because one of the most used corridors for Remitly and sending money across borders is US to Mexico. So they've got Mexican Americans sending money back home. There's kind of a belief that that's going to be under pressure with the current administration. But at the core of it is just your typical innovator's dilemma, like Western Union, MoneyGram. These are as ancient of businesses as you can think. Like Western Union, I think, has been around since the 1800s, actually. There's so much more convenience, speed, savings on just doing it through a mobile app that we've seen this natural transition over the last 2 decades of people going from physical remittances to digital. Part of the reason Remitly has been a winner here is they have made it easier on the receiver's end. So if I'm living in Los Angeles, I'm sending money back to Mexico to my grandma, she might not want to use a digital banking app to receive that transfer. So there's pickup stations. So you can go from digital transfer to cash pickup. There's a whole bunch of different ways that you can receive it. And that is a logistics advantage in a way, because a lot of the online only remittance providers are relying on both sides having a bank account. Anyways, it's been a very good 5 years for them. They have sort of standard mobile app economics. There's some partner banks that are in the cost of sales line, but generally you're looking at 60 to 70% gross margins. I imagine they can get to 20%, 30% profit margins at scale. And it's one of those where it's kind of right on the corner, turning towards profitability. But they've got just over a $2 billion market cap or enterprise value, so 2.4 billion. And management expects that they're going to do 2.8 billion in revenue by 2028. So it's, I think, around 2 times gross profit at the moment. Gross profit's not a perfect metric for earnings because they spend a lot on operating expenses, a lot of developers. They're headquartered in Seattle, so it's expensive. But over time, margins should grow, and you can kind of work backwards into some pretty conservative estimates and still get a good return.
We have a question about TransferWise, now known as Wise, listed in the UK. If you could compare different international payment apps. I was also wondering about Nubank as well. Their main business obviously isn't remittances, but I think they do have some features that enable that as well.
Yeah, I actually own both. The business is called Wise now, and they're primarily European. It's a different customer cohort that they're going after. Remitly is targeting more immigrants. If you look at the most common corridors between Wise and Remitly, there's very little overlap. Remitly is more US to Mexico, US to Philippines. The US is very much the largest senders market, whereas Wise is a much broader mix, and it's very popular in Europe specifically. Wise is geared towards higher volume senders. So instead of going through the correspondent banking system, which is how a typical digital transfer would go, Wise has set up local banking licenses in a bunch of countries, which is very difficult to do. It takes a long time to get banking clearance in a lot of the countries that Wise operates in. It's just basically doing a credit in one account. If someone from the US Wise bank account sends to the UK balance goes up, US balance comes down. It's just their own bank. So they're not actually crossing borders, and they have currency futures in place, and it's the cheapest. That's part of why it's become more popular with businesses specifically. It's mostly small to medium-sized businesses, send contractor payments, whatever. If you have 4 developers in Europe and you're a software company here, a lot of the people will pay them via Wise because it's 0.5% take rate as opposed to the traditional. I think Remitly is more in the 1 to 2% range. Might not sound like a lot, but if you're thinking of your whole salary, taking 2% off the top is quite a bit. You want the lowest rate you can get. So very different customer cohorts. Remitly, from management's perspective, what they say is the biggest value driver is it's secure, multiple ways to receive the money for the receiver, and it's fast. A lot of the time, grandma needs the money tomorrow. They need it today. Remitly will send it instantaneously. It's clean, it's safe, it's easy for pickup, it's secure, and it is cheaper than Western Union, MoneyGram. They don't have the local banking licenses, or they're trying to build it out now. It's not going to be as cheap as Wise, but it's the one that's been adopted in various corridors. I think both will win. I can't even imagine going to Western Union and saying, send this money across borders. So over time, you're going to see a continual shift towards digital transfers.
Nubank uses Wise for those services.
Yeah, that's another element of Wise's business, is that it's like infrastructure as a service, where their banking licenses is in and of itself a transfer service that they can license to other fintechs. It is a nice way for Nubank to be able to offer to their customers cheap transfers without having to build it out themselves.
Before we go to Adobe,
One more question. Does the new tax from OBBA affect these transfers when sending money outside the US?
I think that might be, is that BBBA, Big Beautiful Bill Act? Is that what you meant?
Yeah, so if anything, like Remitly would benefit. So it's on cash transfers, actually. You would think more people would start sending money digitally. It won't affect Remitly. If anything, it would be a benefit to them.
All right, let's move on to Adobe. This is the battleground.
We're going to get a different perspective because I think Adobe is going to be fine, but I think they're one of the SaaS businesses that could eventually long-term get disrupted from AI the most.
I think it's a fair concern, and it's the reason the stock trades the way it does. It's funny that it's a battleground stock because it feels like for the last 15 years, it's been like the no-brainer compounder where it's traded at high 30s earnings multiple consistently. I use Figma, I use Canva, I use Midjourney, which is the AI text to image generation, and I don't use Adobe. But I'm not an enterprise customer. My general thesis here is that the enterprise customers are just going to be stickier than people think. If you're putting a software system credential on your resume, which a lot of marketing or creative design, graphic design, putting Adobe Proficient on their resume, it's one of those things that's just going to be continuously sticky. There are high switching costs. If you're really used to Photoshop, if you're really used to Illustrator, it's a pain to switch. Like I think about it for my podcast editing software. I wouldn't want to switch. It would take me like a month or two to figure out the new systems over time, probably make some mistakes along the way. So if you're paying $90 a seat for Adobe's full creative suite and you're a professional in a marketing department at a Fortune 500 company, people complain about the prices, but it's usually not professionals at Fortune 500 companies that are complaining about the prices, which makes up the vast majority of Adobe's revenue. Since Canva and Figma have been around, which I think combined they've got like $4 billion in revenue, Adobe's added like 12 billion in revenue for the creative suite. They've doubled revenue since Canva and Figma have come onto the scene. So I guess that's kind of the crux. Customers will stick around or be stickier than people think. At less than 15 times EV to EBIT, you don't need a ton of customer growth for things to work out. I think you can get mid-single digit revenue growth, like even 6% revenue growth. Right now, they're reducing share count by more than 5% a year. Assuming margins don't just come down by a ton, you're getting more than 10% earnings per share growth. So I don't think you're going to get extreme returns here. It's not going to be a 10 times larger business in 20 years or 10 years, but especially at a time when I'm looking at a lot of valuations and finding it hard to find some new ideas, this seems like an easy way to get solid returns.
I actually agree with you on some of this about Adobe, Ryan, because I feel like they kind of missed a golden opportunity at the beginning of AI becoming an actual thing for creative professionals, but it's still the gold standard. And everyone that's in a professional capacity is using Adobe products, even if sometimes they may occasionally have an additional seat at Canva or Figma or something like that. Ultimately, they use Adobe. So that makes a lot of sense to me.
Casey and Ryan just called Adobe the Western Union of creative software. 100 years from now, somebody's going to be like, Adobe was founded in the 1980s and it's time for it to be disrupted.
I think Western Union shareholders were pretty happy over the last century. So
Yeah, exactly. The Western Union of creative software.
I hope that's not the case, but yeah, MNDY.com. This one's a little more speculative in my opinion because it's not a huge position for me, but it's not really like a wide moat business per se. Like task management software, there are sort of an endless amount of competitors. Like Trello, Atlassian has a few ticketing management software, Asana. It's not like they're a standalone product that is better than everything else. From what I've read in customer reviews, it seems like they basically built a better mousetrap and it's very customizable. It's a very intuitive tool and it's easy to scale within organizations and add new seats. And we've seen that. At the end of 2019, Monday.com had 76 customers that were paying more than $50,000 a year for their software. Today, 5 years later, they have more than 4,000 customers spending $50K a year for their software. So there has been a successful move up market that's both through a sales-led approach, but also there's been a massive increase in spend per customer. So a lot of the small to mid-sized businesses are adding a lot more seats. You're seeing Fortune 500 companies start with Monday.com. They're starting in a single department and it's growing and expanding to other organizations, so they're adding more seats. So I think it can continue to grow. People think it can be replaced by AI. There is some AI threat, but there seems to be this belief that companies will start building this task management software in-house as opposed to using third-party vendors. So my general belief is that people will continue to use third-party vendors like Monday.com. This is like a general tangent, but there seems to be this belief kind of pervasive across the software industry that companies are going to start vibe coding all their tools in-house. I work at a software company, and it seems very unlikely to me that that'll be the case. Maybe at the ultra large scale, it would make sense. Like Amazon can allocate 50 devs to it. Whereas if I'm a medium-sized organization, the most cost-effective solution is to continue to rely on third-party vendors than to try to build this stuff out in-house. I don't think most companies are going to say, let's build our task management services in-house from now on. So that's my gripe against the AI will kill software debate.
Yeah, and we kind of saw that last year with Klarna, but it ended up just being like a IPO window dressing. They were just trying to pad the profits when they were getting ready for the IPO to try to maximize their take. But at the end of the day, I'm sure they're still using enterprise software within Klarna.
Yeah, the cost of building these in-house may be small, but maintaining them in-house is more expensive. Let's take Stripe, for example. People are Stripe, Adyen, whatever, your payments processor. Let's say they're gouging you on fees. And management says, okay, we're going to build our own payments processor. Let's say that takes 2 to 3 months, 5 developers, like this is very optimistic, just to build a prototype for a payments processor. There's probably a whole bunch of features that you don't offer that the organization is using, like churn analytics and coupon codes automatically being able to populate, use at checkout. There's a whole bunch of backend stuff that's very helpful that Stripe does that would take time to build out. But then on top of it, you don't set it and forget it. You're going to have to maintain that, and it's going to cost way more than you expect. Let's say those 5 developers have to stay on and maintain this payments processing software. That's $1 million a year. You're probably paying more than just the Stripe fees. So obviously depends on the organization, but I think people get my point. It costs a lot and it's not your core focus. So I think it's just easier for most organizations to use a vendor that specializes in this and is constantly iterating on it.
This is why I think the term from the tech world has now become very popular in the investing world as well. When we're talking about tech companies, there's whole stacks of development that have taken, in some cases, decades to build. And as amazing as vibe coding is for a simple project, you can't replace layers and layers of development that have taken place over long periods of time. It's just not that easy.
No, absolutely not. I'm thinking about task management software. It's probably not better than Monday.com. It probably doesn't have all the features that have been built over a decade that make it easy for teams to collaborate and communicate on stuff. And I wouldn't be talking about this if I didn't think that it was affecting the valuations. But it seems that investors are actually really worried about this. That's probably why we've seen a lot of the drawdowns. Monday.com, they're on the corner of profitability. I think they've had 4 quarters of GAAP operating profits now. I think they can get to standard software steady state margins of 20% plus in the long run and continue to grow. So that's my general AI won't kill most of traditional SaaS, but I guess we'll see.
Patience is required. Last decade, the latter half of the 2010s, is when we originally made some of our hardware and semiconductor investments. And it was still largely out of favor with cloud software, SaaS companies being very happy that our big investments in Nvidia, Broadcom, Arista Networks, and Applied Materials happened a decade ago. We rode out 5 years of general underperformance and out of favor action because that's where you get your 10Xs, your 20Xs. Patience is okay. Buying the out of favor stuff is totally fine with us. And the seasoned investors in here will agree with that.
If I can get a comfortable wide moat business that'll give me 10% plus returns, I'm very comfortable owning that.
Yeah, absolutely. The compounding can still happen.
Regarding Airbnb, this isn't really software, but I just think this will be a really big business long term. And it's kind of a classic network effect. The more hosts that are on the platform, the more attraction, the better pricing there is for guests, the more guests, the more incentive there is to become a host. And in North America specifically, I know people hate when I say this, but it's actually sort of a monopoly on alternative listings where you've got, I believe, 50% plus of the listings on Airbnb in North America are exclusive to Airbnb. Internationally, Booking Holdings has a lot as well. So it's not a monopoly abroad, but they've completely disrupted the way people stay when they travel. And it seems like sometimes investors have a bad Airbnb experience and they get kind of sour on the business, but I've had a lot of bad hotel experiences. Doesn't mean the hotel industry is going to be destroyed. I don't think they're going to see hyper growth. It's a mature business already. I think there's 8 to 9 million listings on the platform, but I think they can grow at 10% plus for a long time. And there's a lot of levers they can pull as a marketplace, like sponsored listings to me feels like a no-brainer. I don't think it would destroy the customer experience either. I don't know why they haven't done it yet, but it seems like an easy lever to pull that would juice profit margins by quite a bit.
What do you think has been holding Airbnb back? This is one that we have in our portfolio that I've been ready to cut bait for a really long time. Nick has not. Nick has been faithful. What do you think about that?
Their largest market at the moment is North America, US in particular. They've made a proactive push to try to keep the average daily rate consistent, more affordable, make selection more available, which has been a headwind to the top line in North America. Long term, I think it's a good choice for the business to be trying to keep the average daily rate consistent, incentivize more hosts. Ultimately, the thing I really like about Airbnb is not only do I consider it an emerging moat, but it's very easy to track the moat. Are listings growing on Airbnb? If listings continue to grow, that means the business or the marketplace is becoming more valuable in the eyes of travelers. I think the average daily rate pressure is one of the reasons that growth has been a little meager, but the other part is that maybe they are closer to maturity in North America than people might think. Airbnb is already very popular here in the US, but internationally, they've had a lot of success. I think Brazil, Japan have been huge markets for them. I think you can see much quicker growth there. I would almost rather see them grow the top line at a sustainable rate because there's a lot of moving parts to the marketplace and you don't want to degrade the customer experience in the process, which sometimes I think you see that where marketplaces grow really fast, but hurt the customer experience and customers don't stick around. So you got to ensure quality with the stays. You got to have all the protections in place and stuff like that. But I would be on Nick's side here. I don't think it's not the cheapest stock in the world, but I think margins can be much higher than they already are. And Chesky likes to try stuff, which can be costly. I don't think the experiences stuff is really going to work, in my opinion. They've tried this before, and allocating a bunch of developers to it is maybe not worth the effort. But that's my opinion, and I could totally be wrong, and he might have a better sense of the market there. And they've built a business that can afford them the chance to have a few strikeouts on other initiatives. So, yeah, I would continue to hold personally.
We should mention we do own Booking Holdings as well, because you're right. That's the big established model, especially overseas outside of the US. And Airbnb has kind of run up against that. It's tried to move internationally. It's not like the network effect of Facebook in its early days where it was just white space for them to take over a brand new market. So there's some headways there for them, but I do think it is a network effect. It's a strong business. And I think it has the optionality of a software social network, even though it's basically extracting operating expenses from real estate owners via software. It does have the optionality of a software business. So we're willing to be patient along with the ownership of Booking Holdings. And unfortunately, didn't get in on Expedia in the last year, but that's okay. Can't win them all.
I think all the OTAs, they're going to win with the growth of travel, which has been very much a long-term tailwind for all of them. And you look at the gross booking value of all three, Expedia, Bookings, and Airbnb, and they just continue to grow. It's not the fastest growth in the world, but it's above average.
What's our current take on ServiceNow? This is one of my favorites. But what's been going on?
multiple acquisitions.
Yeah.
In addition to the general SaaS software sentiment just souring in the last few months, especially, ServiceNow has made 2 cybersecurity, identity security acquisitions. We are going to do the 2-year refresh on our cybersecurity industry deep dive, but there's not going to be any spoilers here when we say identity management and identity security is a big component in AI right now. So for any company like ServiceNow trying to build AI agents for its customers to utilize, making sure that those AI agents are accessing only the data you want them to is key feature that you need to have squared away. So I think the market still doesn't really understand this. Why is identity security such a big deal? Obviously, Palo Alto Networks acquiring CyberArk is the big one, but there's actually been a lot of acquisitions of identity security startups in recent months. ServiceNow has really gone big on this. And so in addition to just the general SaaS sentiment going south, ServiceNow has blown out more than half of its cash on balance on these acquisitions. And so that also has to be accounted for in the valuation too. When you have $10 billion in cash on balance and now you have less than 5.
I don't know a ton about ServiceNow, but anytime you see a chart where they have a net revenue retention rate of 98% pretty much every quarter for 5+ years, that is worth looking at more. So this is the customer renewal rate since 2019, and you might not be able to see much discrepancy, but it's basically 98% plus for the last 5 years. This affords them the ability to spend so much if they want acquiring customers, because when you only have 1 to 2% of your customers leaving on a yearly basis, your lifetime value is like 50 years. So you can spend a lot to acquire customers, but that's probably one of the best customer renewal rate charts I've ever seen. Sometimes a chart like this actually concerns me a bit because it's almost too perfect. If it were anything but a software business with 99% renewal, I would think this must be a fraud. It's an astounding chart.
It really speaks to their ability to launch new product categories. And they've gotten really aggressive in the last year with the introduction of CRM software as well. Charts like that look great until suddenly they don't. And then we're in real trouble. But if that continues, I fully expect ServiceNow will be our largest software holding within the next 5 years.
I did want to give just one sort of amendment to what I said earlier. I maybe sounded somewhat pessimistic about AI's ability to disrupt software. Workflow software, I think it's going to be harder to disrupt, but there are areas where I think it will create sort of a new wave of competitors that no one's even thinking about today. Fiscal.ai is the one that's in mind for me. Data aggregation can be aided by AI. If your business is centered around data aggregation, being able to aggregate financial data with AI is much less costly than doing it with manual teams. So it can be disruptive. And I imagine there's a lot of other industries where it's like that, where you've got either manual data entry or something and you become a data infrastructure provider. I think we'll see headwinds either in terms of pricing pressure or potentially an increase in churn from customers as well.
So you're thinking like your S&Ps, those type of companies.
The thing about S&P and some of the other big data providers is they have some stuff that is hard to replicate. They have developed partnerships with banks. Getting estimate data is really difficult. That's something that they've developed over decades by having partnerships, and you can't just build those from scratch. Historical data can be aggregated, but estimates are discretion. It's subjective. It's kind of got to come from someone. There's certain data feeds where it's very hard to replicate. And I'm using that example because it's the one I know, but I'm sure there's other industries as well where they rely a lot on aggregation of some sort, and there'll be waves of competitors that come along that are powered by Gemini or OpenAI or any of the other main models that make it substantially less costly to do business, which means they can be competitors on price as well.
There are a lot of very old businesses that have been fantastic compounders built on that data that could be at risk. The financial industry is an obvious one, but we finally have some businesses that generate real revenue from blockchain, like Circle, Internet Group, and Figure Technology. And it's kind of a big deal to disrupt the financial industry because the sector is so big.
Yeah. A lot of the big institutions, they haven't really seen competitors for a long time prior to AI. Building a competitor to a financial data provider would have been a nightmare. It'd be super costly. But yeah, it's an industry that has not seen disruption, I don't think, for quite a while.